Hey, it's Susan Cook with The American Dream, and your host for the Explore My Town, and we're doing something a little different today. I'm talking here with Spring Henry with
Motto Mortgage.
Motto Mortgage, sorry. I just gotten to know Spring a little bit, and I didn't really know her company's name as well as I should, I suppose. Spring, thank you so much for coming today and talking to me a little bit about mortgages. And we've talked about some questions some 5 misconceptions about
First-time home buyers
have about mortgages.
5 things that they're not sure about. Number 1 being that a lot of people think you have to have 20% down, and that is just a misconception. Most lenders have 3 to 3.5% programs that they can work with first-time home buyers with. And many lenders have down payment assistance programs that they use these days.
Yes.
So there are no longer 20% down payments required.
Yep. And here in Valdosta, we have USDA loans too.
Absolutely, and that is no money down.
Right. And with these let's kind of side note here. With these no money down programs, what kind of credit score do you have to have?
Well, that is a second misconception that first home buyers have.
Look at that.
Most people think you absolutely have to have a 620 credit score. And that is not the truth. Many lenders can go down to 580, and some lenders even offer all the way down to 500. Now, of course, that being said, you have to be cautious about what's on the credit report, but the possibility is out there.
The possibility is out there, and if you're recovering from something in your life, because life happens, we all have life, but it shouldn't keep you away from being a homeowner if you're systematically working to overcome those issues. And if you get to 580 and you're working to overcome those issues, you could qualify for a loan.
Absolutely.
That's
That's important for people to know.
To know that. Don't give up.
Now, let's say that you have your 3% down and you've got your 580 credit score. And so you're thinking, oh, great, I'm ready. I can get a loan. Well, there's one more thing you have to think about, and this is our third misconception, and that's that the down payment is the only thing you need. And that's not the case, because you also have to consider closing costs. Closing costs are going to pay for the attorney's fees that help close the loan, taxes, lender fees, insurance, all the other things that you don't think about. Many of these prepaid interests have to be paid ahead of time through the closing costs.
So I know, because I negotiate a lot of that into the sale of the house. I know that in this area, in Valdosta, our closing costs are about 3.5% of the sales price. Okay. Sometimes it can be a little lower depending on if you need to buy down the rate, or if you need extra things with the lender, to get a better payment or something like that. It could cost more, but that's a conversation you have with your lender when you do go in there. But for the most part, just straight up, you got the loan and everything, 3.5%. So on a $200,000 house, that's going to be around $7,500.
Now, Susan, from the real estate side of that, is there anything that you can do to help these first-time home buyers when looking for a house?
Okay, so
with the closing costs.
With the closing costs, so usually what I ask my clients is I tell them it's going to take 3.5%. And I throw that figure out there because we all like to know. We don't like surprises. We want to know what to expect, right? So I usually tell them that it's going to cost you this much, and how much of that are you going to pay? How much of that are you willing to pay? Okay, well, I have a VA loan that's 100% financing. What do you mean? That doesn't mean the closing costs are financeable. Your funding fee is financeable, but your closing costs are not. So I usually start with that question, and we go on from there. And if they need all of it, then we'll need to find a property that will allow us to negotiate that. That's not going to be a house that's 2 days on the market. We're still in a tight inventory here in this area. And if it's a beautiful house that is $175,000 and you want $7,500 in closing costs and it's been on the market 2 days, we're not going to happen. It's not going to happen. Okay. Now that's extreme. That's an extreme example, but that is, the way that I talk to my first-time home buyers. We talk through all of the scenarios, and when they present a house to me or I present a house to them, we talk through the financial part of how we are going to structure a offer, even sometimes before we even go to look at the house, because some first-time home buyers are cash poor,
Right.
and that's the case here too. We are a military town, and these military kids, I call them kids because I'm a little longer in the tooth, but they don't have a lot of cash, so they are dependent on me helping them negotiate that, and also all the other things that I negotiate. But that's not what we're talking about. The loan. But that's what I normally do, and I have been able to get closing costs, I would say 95% of the time. Now, sometimes it doesn't work out like that. And sometimes it doesn't work out like that. And we just have to work through it. There's gift money you can get from family members and things like that. But you have to have an agent that's going to have the kind of conversations with you up front about financial things. Otherwise, you get to the end of, you get into the negotiation period of a contract, and people are disappointed, and or you get to closing, and it's even worse.
Yes.
If you haven't ever had a canceled closing, yeah. So
And that kind of leads us into the fourth misconception.
okay,
And that is that if you have good credit, you can get a mortgage.
yes,
Credit is important, but it's not the only thing. As we just said, you have to have some assets. And not only do you have to have assets, you have to have some income stability.
excellent.
Lenders want you to have a stable job. And with that being said, for our first-time homebuyers that are just getting out of college, your college can count and go in with your income. So there is that. If you went to school to be a nurse and you've only been a nurse for a year, you can count your school time to support your income stability. So that's a common misconception, that just good credit. You got to have the other things to support you as a buyer.
And then
The fifth misconception for first-time home buyers is that when you purchase the home, you're making your monthly payment, you're just paying the principal and the interest. And this is probably one of the more important ones, because actually your mortgage payment is your principal, your interest, your taxes, because Uncle Sam must get his part, and your insurance. Not only do you have to have homeowners insurance, but you also have to have mortgage insurance. All lenders require that unless you put more than 20% down.
yes,
So all four of those areas come together to make up your monthly payments. So be sure when you're looking and shopping that you're considering the insurance and the taxes along with your investment.
yes, and a lot of people will look at that. I know that I've had these kind of conversations with buyers. They will look at the link that I send and look at the mortgage calculator from the website, from our MLS, and they will think that's going to be their payment, and it is missing the insurance factor on there. So I always point them towards a mortgage calculator that is a little more friendly for that. I actually have one on my phone. So I have some of these preliminary conversations, but really and truly, you should be talking to a mortgage professional about what your payment is going to be and what you want. I had a deal fall apart just today because the borrower could not understand why he was getting one payment and the other. When he got quoted with his preliminary quote from the mortgage lender after we went under contract, it was substantially higher. And so and part of the reason was the taxes and the insurance.
Yes.
It's not just the principal and the insurance. Then that can add $300 sometimes to your mortgage payment. And that's substantial when you're talking about a first-time home buyer.
It absolutely is. And all they have to do really is, I think most lenders these days have mortgage calculators on their website. I know at mine, at the bottom, I have a link that has mortgage calculators, and it inserts the proposed insurance and taxes for you to kind of give you an idea. So if you're using mortgage calculators, make sure the one you're using includes taxes and insurance.
And also the PMI too, if you're using something besides VA. VA is the only 100% loan that does not have private mortgage insurance, what we call PMI in the industry. So, well, I think we did really good. So look for me in spring to come to you with some of these things. We're going to come up with some other topics. If you see something that you would like for us to talk about, shoot either me or Spring a line, and we'll see you next time. Thanks.